Good morning. This is Jim Colburn of Commodity Research Group. I'm here with Andy Lebow, also of Commodity Research Group, and we're here to talk about energy markets. To learn more about us, you can check out our website at commodityresearchgroup.com, where we post our podcasts and blog. We would like to thank our friends at EKT Interactive Oil and Gas Training for hosting this podcast. Check out their newsletters, podcasts, and learning modules at ektinteractive.com. This podcast should be construed as market commentary, merely observing economic, political, and market conditions, and is not intended to refer to or endorse any specific trading system, strategy, or recommendation. We are not responsible for trading decisions taken by anyone. Information is not guaranteed to be accurate. This is not an offer to buy or sell any derivative. Today is April 18th, and it's about 11 a.m. New York time. And welcome, Andy Lebow.
Hi, Jim. How are you doing?
I'm doing good. I just want to say this is these podcasts are kind of a continuation of a conversation we started, I'd say, September of 1988.
I'd say that's probably correct.
And
So it's a long-term conversation.
a long-term conversation
It's
and
been through many ups and downs.
many ups and downs, and we've got a few more today. So let's kick off. I'm thinking, China demand, Russia supply, OPEC policy. Let's start with China demand. I think it was yesterday. Some stats came out. GDP growth for the first quarter in China were plus 4.5%. World Bank has that region. They're looking at plus 5.1% GDP for the year. Are you seeing that sort of increase in oil imports and oil demand in China? Andy, what do you want to say
Well,
about China?
yeah, definitely seeing an increase in imports and exports, actually. China in March set a record for crude imports, and they also set a record for exports, product exports, and crude runs, I think also were fairly high, which makes makes all the sense in the world, really. It's hard to say what went into inventory, what went into runs. That's hard to parse. But what's interesting, if you take the numbers as they are and just look as we do on crude runs here, on the crude numbers here in the U.S. and try to figure out apparent demand. If you took crude production plus or minus net imports less runs, and you try to get and change an inventory, you get a feel for what the apparent disappearance was domestic, and it wasn't really that great, Jim. If you took those numbers, it was up, maybe 100 or 200,000 barrels a day in the first quarter relative to a year ago. I suspect it's higher than that, but the actual numbers are so far in the first quarter. I don't think it's a boomer for first quarter. The big hope is as we move on into the second, third, and fourth quarters, it's really important to this market that China comes through with big growth numbers. There's estimates of a growth of 1 million barrels a day by the IEA. We're the CRG, we're up 0.7 because we're not so sure first quarter was that great. So, yeah, and you're also having comparisons to last year. Last year was soft in China because of all the lockdowns. But nevertheless, China, for this market to really have a significant rally in the second half of the year, and I know we're going to talk about this, China really has to come through with significant demand numbers. So that in a way, as copper is oftentimes, for the petroleum market, spotlight on China, no doubt.
Yes, and I think we'll talk about it in a minute, but there's a divergence between the big three monthly supply demand estimate groups, the EIA, the IEA, and the OPEC. So we'll talk about that in just a minute. But for the rest of the world, it's kind of, or the OECD, most of these groups agree that increase in demand for petroleum is kind of flat this year.
Well, for OECD, yeah, the you look at US, maybe we're going to be up a little bit over last year. Europe the same, maybe a little bit up over last year, depending on obviously depending on the economy. Weather had a factor certainly in the first quarter in the northern hemisphere because we had a milder than normal winter in much of the northern hemisphere. Thank goodness, really.
Yeah.
So that was a factor, and we'll see as we move on into the second and third, and into the balance of the year. Whether we go into this long expected recession or skirt it, but it doesn't look like the OECD demand is going to be that robust. It looks like no growth, at least for Europe or US, or if there is any, it's really going to be pretty slight. The growth is really a non-OECD. I think China, as I just spoke about, India is probably going to, that could be up 8 to 10%. But no, that sounds great. Wow, up 8 to 10%. But India, even though their population is just past China, India's demand for petroleum is only like around a little over 5 million barrels a day,
Right.
while China is expected to be, the fourth quarter as much as 16 million barrels a day.
Right.
So, that's a big, there's a big discrepancy right there. So a 10% increase, it's still great. I don't think it's going to be 10%. I think it's more, maybe 6 to 7% for India in terms of actual demand, not that great. And then the rest of Asia, if China does come through with big numbers, that's certainly going to help the rest of the rest of Southeast Asia, South Asia, China and India, and the Middle East also. You might see some decent demand out of the Middle East. I don't think so much out of the Americas, out of South America. I don't, I don't think we're going to see anything. Maybe slight demand increase. So, when we put it all together, we're looking for, there's the big three,
Right.
and then there's all the banks, and
Yes.
then there's CRG,
Little CRG. Yep.
little CRG, and
Little
I think
engine that
Jim,
could. Yep.
and I think uh, Jim has, seen a lot of these estimates. Has seen every estimate over the last X number of years,
Yeah.
and I think little CRG does pretty good.
You do. You're very good, Andy. And why don't we just why don't we go talk about Russia supply on the market, and then we'll pull them both together and talk about the different groups' estimates and where you stand. So, you know, a lot of stories like Russian products showing up in Saudi Arabia, UAE, and part of that China refining is from discounted Russian oil. Same with India. What's Can you kind of sort it out for us?
Well, the Russian story since the invasion has been, the market has kind of misfired on where they think Russian production is going to be, or even what it is, and it's been difficult to get those numbers right. You do remember that right after the invasion, like the IEA was saying, well, Russian production is going to be down, could be down 2 to 3 million barrels a day, and last year it was hardly down at all. In fact, at the end of last year, they were right where they were pre-invasion, which was like, over 11 million barrels a day, including condensates, 11.1, 11.2. It looks as though, I think for the first quarter, they probably reduced production slightly, maybe a couple of 100,000 barrels a day, maybe. Now, no, Alexander Novak, their ex-oil minister, I think he may still be oil minister, but Novak was talking about Russian production being down 500 to 700,000 barrels per day this year, crude production. And I think that has a chance to being right. That the last OPEC meeting, OPEC Plus meeting, they did say they were going to be down 500,000 barrels a day over the balance of 2023. But I think we'll see. We'll see. They have been able to. They just had record in March. They just had record seaborne exports despite the embargo, despite the EU embargo. Crude and product exports were like 600,000 barrels a day
Uh, could
above
some of
Russia.
that, sorry, could some of that been, buying ahead of the embargo, a
Yeah,
little extra?
that's a good right, right, definitely.
So we're gonna
But
you go ahead. Sorry.
but diesel is showing Russian diesel is showing up in Asia, Latin America, I think some in India, and certainly in the Persian Gulf. The Saudis have been happily taking in discounted Russian refined products, taking it into their systems for domestic use, and exporting Saudi product, and making that's a great trade for them.
Hmm. Yeah.
Now, Russia's going into some maintenance now, so presumably there'll be less refinery maintenance. So presumably there'll be less product on the market over the next, in April or May. I'd expect those March numbers will still be down, but the numbers that we had thought, Russian diesel down like, you know, 600,000 barrels a day or something like that. That hasn't come to fruition,
And
and it's pressured the diesel market.
so you see that showing up in the diesel cracks.
Oh, totally. Yeah, yeah, yeah. Singapore cracks are really weak. European cracks have come off. US cracks have come off. So again, the market expected one thing, didn't really expect that Russia would be able to so easily and quickly pro, you know, find home for their refined products, but it took them no time at all really to get
Yeah.
to redo their distribution map. Similar to crude took a little bit longer. So in any event,
So
the
uh,
numbers that we're using for Russia is like 10.5 million barrels a day production for the balance of the rest of the year, which would be down like point 0.5, point 0.6. But like OPEC is using 10 million barrels a day for OPEC production, which for I'm sorry for Russian
Russian.
production, which is I don't see that. I don't think they're going to be down over 1 million barrels a day.
And how are they doing with the $60 price? We're hearing
They're
stories.
doing great, Jim, because it's not it is over $60.
It is over.
Yeah, yeah. The West has really you haven't really seen the West heavily policing the price cap, or a lot of the embargo. And we'll see how hard the EU and the Biden administration is going to come down on Russia, if it on I guess it would be India or China or some of the other end users. That remains to be seen.
Yeah, the U.S. has an inflation issue and an election
Yeah,
next year,
right.
so their interest, our interest is to have oil on the market and not be, not show up in the CPI,
Right.
you know,
Or at the pumps now.
at the
Unlike
pumps.
last year, this is not an election year, so
Right.
there's a little less pressure on the Biden administration.
But to,
Um,
but they're always running.
they're always running. Yeah.
Yeah, yeah. So I mean, it's interesting also that talk about Saudi Arabia. The Chinese broker this what we call peace deal, and between Iraq, I'm sorry, Iran and the Saudis, and it's perhaps going to help with the fighting in Yemen, and which is what the U.S. wants to see. And then the Saudis go ahead and raise or cut production and raise prices, which the Chinese can't be happy with. I mean, that's so I unless maybe they are getting contracts to build the new city that
Right.
the leaders of Saudi are investing in.
Right. You never know, right?
It's
You don't know what goes on under the table.
yeah, it's a very complicated game. I mean, you think about trying to restrict Russian oil off the market. You don't want Russian oil off the market. You just don't want them to get a good price because the whole world economy will pay if you
Right.
right. So yeah,
Which
very
is probably why the policing of the cap has been pretty non-existent, actually.
yeah. And I think I mentioned that to you a while ago. Is why wouldn't the U.S. look the other way if Iran started producing more oil and products on putting them on the market? And are they you seeing increases in Iranian oil and products in the world
No,
markets? Steady.
steady at 2.5. And I think
That's
the Russians carefully in um, preparation for the embargo, the Russians definitely carefully studied the Iranian tactics on, how to get around the embargo, including, what ports they could use, ship to ship transfers,
turning off the GPS.
turning off the GPS. Yeah, they used all the Iranian tricks, and yeah, and it's been successful for them.
Yeah, and they Russians also probably have more willing buyers. India and China and others.
Yeah,
Yeah,
exactly.
yeah.
Yeah.
Very good. So why don't we just quickly move to OPEC policy? What do you want, or Saudi policy, whatever you want to call it?
Well,
What's going on? What do you want to tell
well,
us?
yeah, I think there've been a lot of different views on OPEC seeing, that the rest of the year that demand could be soft, and that's why they cut production. When in reality, if that's the case, they obviously didn't read their own research because the OPEC report has demand booming
Right.
in the second half of the year. So I tend to poo-poo that. I don't think that was a factor at all.
Well, they did do it
Um,
after our banking crisis, which the people who were expecting recessions later this year were voices were louder after that. So it's still possible, and it's not like these big three, OPEC, IEA, EIA, have done a good job forecasting demand. So, if,
right,
you know,
right.
so
And, and
I hear what you're,
Saudi has their own information and great information because of Aramco,
right.
and they see what their customers are doing. For so I think that was yeah, maybe there was a little bit of that, but it still looked like even the EIA is looking for builds, but even the most pessimistic forecasts were looking for draws in the second half, or unchanged on inventory. But I think the point you made that the banking crisis and price got down to $64 on WTI, which was is completely unacceptable to the Saudis. But I think, to me, the cut was it was revenue related, just price related. I think that so far this year, Brent up to the first quarter when they made the cut, Brent had averaged about $81 and WTI I think was $76. So, to me, the Saudis were looking to protect at least $80 Brent and really would like 90 to $100 Brent. And what I think happened, is that it was more of a revenue need. They have big infrastructure needs. You mentioned the new city that they're building and, some subsidy needs as well. So, to me, the cut was more about money than anything else, Jim.
Yeah. Okay. We'll go with that. Definitely. It's just Saudis. We've been following them for a long time now, and their policy. I mean, that was a big surprise to the market. That people were talking about them being like the Fed of the oil markets, and you know, I thought it was interesting that they are reacting quickly to a situation that really hasn't of weak demand that really hasn't quite unfolded yet.
Right,
Whereas our Fed seems to react, at least when interest rates are really low, they take a long time, to react to things, and then they overreact. It's so
right.
so I have to say I was a little impressed by that move. Okay, so we have these three very, what we say, difficult to predict entities: China demand, Russian supply, OPEC policy. Let's look at what came out this month with the EIA supply demand estimates, IEA, and OPEC. And we already talked about how they diverge, but it seems to be mainly in the demand numbers. So can you
Oh
kind
yeah.
of and also it shows up in the second half with stock builds and stock draws. Can you just kind of summarize what the differences are
Yeah,
for
if we
us?
look at if you look at what we just talked about, OPEC and what they're looking for, they have demand up like 2.3 million barrels a day this year, but a huge increase in the second half of, let's see, they've got 100, they have about 102.5 million barrels a day, which is a growth of over two, I think it's 2.5 for the second half. So they have a big increase in the second half. I mean, really big numbers. I'm not sure, again, the driver is they've got China demand as very strong, Asian demand as strong, a little bit better, slightly better OECD demand, but those numbers are eye opening, to say the least. And as I just said, if the Saudis were really using those numbers, there's no way that they would cut production.
Right,
Because it really, you're looking at the need for more, like the call on OPEC is much higher than what they're going to produce if given the given their last agreement. So and OPEC, the OPEC OMR has a draw of over 2 million barrels a day for the second half of the year. Again, that's enormous. And if we do draw 2 million barrels a day, we're going to get really tight. I mean, if you look at inventories, there's still, there's still about 70 to 80 million barrels below normal. So it's not like they're really tight right now. But you take 2 million barrels a day off the market, and things will get unbelievably tight.
so
But again, that's based on huge demand, and I might add that they, as I think I mentioned earlier, they have Russian production way down. So they're singing a really bullish tune. Of course, let's not forget who writes this. It is the OPEC. It is the OPEC report. So
yes, um
now,
but go ahead. you
no,
you
I
go.
was going to move on to the IEA because they
Okay.
also have eye-opening demand in the second half.
Yes.
Um, and their draws based on where we think OPEC's going to produce, and where not their own non-OPEC increase. Their draws are about 1.5 million barrels a day for the second half, which is a lot. Another big draw for
Mhm.
second half.
So and the EIA has uh,
Now the EIA has built,
builds in the
they
second half.
they have builds across the board. And why is it such a difference for OPEC and the EIA, IEA, is they have demand running at, like I would say 2 million barrels. Nah, that's not 2 million. It's a million and a half barrels a day lower than OPEC and the IEA in the second half.
Mm.
So they're way more conservative.
But all three are showing increasing demand environment. So I guess what I feel is missing in this market is we're not seeing a lot of bullish play. So I watch the option market, and you can follow the paper flow and get a sense of what people are thinking about prices away from today's price. So if you see, $10,000 calls trade, usually that size is put on, initiated by buyers, and maybe it's for December of the next year. So we saw that kind of paper flow before the war, like well before the war, and the sort of the fundamental view was we're not investing in oil fields anymore. So next year we're not going to have growth in supply, but we're going to have growth in demand. So I guess my question is now I don't see that. They got a bonus from the war driving prices up, the people that were expecting high prices. And then after the war, we saw a lot of, not after the war, after the prices started coming down post-war when Russian oil was not restricted as much as everybody thought. We did see bullish paper flow. I don't see it. Haven't seen it, you know, in a big way in a while. And so my question to you is, what from these scenarios, what does the market have built into it? Like the IEA scenario, the OPEC scenario, which are close, or the EIA scenario?
Or let's get to the CRG scenario.
I'm sorry, of course, the
Come
CRG.
on,
Yeah,
the CRG scenario.
right.
We have, and we think, like I said, we're pretty good at this, despite the fact we don't have the big staffs of
Yeah.
these other agencies. We're looking for a much more modest draw in the second half
Hmm.
of maybe a million barrels a day, maybe slightly lower than that. And I think our numbers are pretty. I think they're good, and I think if that's the case, I think the market hasn't quite built that all in, but I think the market, if our numbers are right, then I think we're looking at a grind higher from these levels. I mean, it looks like the market's going to back and fill a little bit now,
Hmm.
but I think ultimately, if we're right, we'll see a grind higher. If OPEC and the IEA numbers are right, the market's going to $100, so it's not built in. I don't think it's built in at all. If we're drawing 2 million barrels a day, we're going higher.
So I don't want to. I'm not. We don't put out trading recommendations. This is not a trading recommendation. But if you're believing the IEA and the OPEC scenario, you're buying this market, and if you're the EIA CRG, you're selling strangles,
Yeah,
right?
I
So
think I think that's right. I think
keep,
those are the right, that
keep
you just position yourself for kind of a grind. I think it's going to be up. Certainly, there's a lot of scenarios to play out, not the least of which is going to be, where's the global economy? But yeah, I think selling strangles is probably not that I would do it, but that's probably the play.
yeah, it's surprising me because we have seen this scenario for these two. The divergence has been around for a while, and we had, as I mentioned, I didn't see the bullish paper flow. There is. I'm not saying it's zero. I'm just saying it's not overwhelmingly bearish. But um, coming out of Sierra, it there. I know producers are often bullish. They're optimistic on prices, but it seemed like it was an extreme bullish meeting. If you talk to people who were there, people were very optimistic about prices down the road, and I'm thinking, I still don't see where are the plays, and I guess what I was missing was that maybe producers hadn't hedged at that point, and when we had the banking crisis and prices came down, there was one day, 3 days after the low was made. So this would have been on March 23rd, where put volume was actually higher than call volume, and that's like man bites dog. It's not something that happens in the recent history. It's not something that's been happening a lot. So I made a note of that okay, so we bounced a little bit off the lows, and some producers are probably saying, you know what, we're not hedged, and so let's put some bearish plays on to cover. And then now it's kind of a balance. You're getting the same amount of volume on both sides, puts, calls, open interest increases is pretty much the same, and there's still some sort of legacy trades on. So if you look at the big open interest in WTI, it's the June of this year, the 119, 120, and 121 calls all have a pretty good chunk of open interest. Same thing in Brent. The big numbers are the June 149, 150 calls. That's big chunks. But again, those were put on. I don't remember exactly when, but it's not recent. So in implied volatility is around 33%, which is maybe a little lower now than long-term average, because recent 2020 had record high. 33 used to be the average. It might be like 34 now, so we had some recent high volatility, and so there does seem to be a grind ahead market, despite all the uncertainties on people forecasting supply and demand going forward, and the uncertainties of how the war in Ukraine will play out eventually. We're getting back to average vol, which kind of tells me that your grind idea is kind of in the market.
Yeah, that makes a lot of sense, Jim.
Yeah.
And that's what it looks like. Of course, as we know, there are there's always event risk and geopolitical risk. We were pretty confident in our trading range over for the last few months, and the banking crisis just took $70 right out, and we got down to 64, and the flow was just incredible of long liquidation, and actually increasing, and shorts increasing the market. And then on the way up, that was the shorts were covered. I mean, I don't think I've ever seen swings like that in the Commitment of Traders report.
Yeah, that was pretty
It was
amazing.
crazy. Yeah,
Yep.
it was amazing.
Did you think that the price action from the OPEC decision was impressive, or did you think it should have been higher than that?
No, I thought it was I thought it was pretty impressive. I mean, now there was a big gap up, and then we've consolidated these last couple of weeks, and that now it looks like some of the recent length is exiting the market. And as I said, maybe to use a classic commodity term, back and fill.
Yes.
Maybe we end up filling that gap, and again, just just doing a grind.
So
Uh,
so so back when you were the only analyst covering heating oil, were you a technician or a fundamental guy? Because you slip in a few technical, like we got to fill a gap. That's
well, Jim, you know my game. I talked a really good I talked a fundamental story, but I was studying the charts.
yeah. Charts have to
So
look
that
good.
was so I was a closet technician,
What's it?
and I got called out a few times,
Yeah, I
more than a
think.
few times over over the years.
Well, I think if there's one data point that's pure, it's the price. those
Yeah,
things, people actually bought and sold at this. There's, no, as I always say, there's a lot of information in that price, and that's why I think a lot of what was really good. What I like about your analysis is that you kind of plug in, what's in the market already, or like you're seeing the Chinese oil being refined and exported, and it's showing up in diesel cracks declining. Things like that, where the fundamental stuff that you're hearing about is actually
yeah, it
showing up.
makes sense. It
Yeah,
actually sometimes the markets make sense.
sometimes they make sense. Yes. So front to back crude curve makes sense or doesn't make sense. It's a
Well,
little,
it's slipping into contango now.
yeah, the
So,
front
and
two,
the Brent market is getting a little bit softer now. Brent, I could see, there are some refinery maintenances that are going to be going on over the next month or two. China's also taking a maintenance, so you could sort of see that. Also, these and also, it's unclear whether when the barrels are going to flow out of through Iraq, because that's been down 450 a day on the dispute. They keep saying any day, and I don't know if the market's pricing that in or not. But the curves are softening. Dees red Dees was 50 cents a month a couple of just a few days ago, looking for the market to get tighter and tighter. And that's given like a dollar back. It's back to like 40 cents a month, something like that. And again, that may be just, flow and profit taking. To me, it does look like globally things will tighten, whether they get crazy tight, like the OPEC and the IEA says. As I said, I don't see that, but you would think that the backwardation is going to hold.
right? And the we talked about the diesel cracks coming off for a while now, even before the OPEC announced that news cuts. How What are you thinking about gas cracks? They're holding up.
Yeah, they're really holding up, and gasoline is a little skinny going into the driving season here on inventories. The last one just came out, and we're at like 223.5 million barrels, and that's 12 million behind the 5-year average. And day supply is like a half a day below the 5-year average. The other thing, demand in the first quarter was way better than I thought it was going to be. Now, those aren't, those are with the weeklies, so you don't
Hmm.
know whether that's right or not. But U.S. gasoline demand looked okay. But
Right.
it was up like I think it was 200,000 barrels a day, which is miraculous. So that at least is something. There's something out there that gasoline demand may not be totally dead.
And you are seeing critical mass in EVs when you do your gasoline demand
Yeah, it looks like,
numbers.
it's definitely a factor. Yeah, yeah, yeah. It's definitely becoming a factor.
And that's
And I think obviously with some of these new regulations that the Biden administration is putting out, they're hoping that, what was it, by 2032, two-thirds of the sales are going to be EVs,
mm,
either 2030 or 2032. And right now, only 6% are EVs. So there's certainly they think there's going to be a big, there's certainly room for EV demand to increase exponentially.
wow.
But right now, I think it's definitely having a factor on the apparent demand numbers. Yes.
Now this is a conversation I had with somebody, and I don't know the person really well, and I don't know how well informed they were, but they were talking about possibility of a RINs market for hydrogen, and I was thinking to myself,
God.
hmm, that's right. Oh, oh boy, they, they learned nothing.
They learned nothing.
Yeah.
That
Anyway.
was one bad product, but that's
Yeah.
that's an aside.
Yeah.
Um,
So, well, anyway, that's an aside. What do we miss, Andy? What do you want to talk about that
I
we didn't
think
talk?
we have. Yeah, I think we've hit a lot. I mean, diesel, we talked about the cracks coming off. It's interesting that they're coming off here in the US because distillate stocks are pretty low.
Right.
That they're 112 million and the 5-year average is like 134 million. The day
Mm.
supply is 5 days. So,
Is it
maybe
seasonally? Is diesel strong right now with planting of?
usually is planting.
Yeah,
You know that. You're
I
an
know.
old ag guy.
USDA definitely
USDA.
put out to help with the
You're
WASDA reports, World Agricultural Supply Demand Estimates.
right. You're a alumnus, a USDA alumnus.
By the way,
So
just one more aside. When I joined the USDA in 1981, one of the significant numbers that we were forecasting was the Soviet Union wheat demand number because it was just you know the great grain robbery where uh, the Russians came in and bought a whole bunch of wheat very quietly in the U.S., only to see prices spike after it came out that they bought so much. This was the World Agricultural Outlook Board was set up, and that's where I was an assistant grains analyst. So we were put. So it wasn't until I don't know five. I stopped after I left the USDA. I didn't follow the grain markets that closely because I eventually got into energy, and it wasn't until about maybe 5, 6 years ago where I saw that Russia and Ukraine were huge exporters of wheat. I go, whoa, when did that happen? So yeah, it was a big. These markets change, right, Andy?
yeah,
They're constantly changing. So
thank goodness.
yes, well,
This one's always changing. So
yep,
diesel, yeah, I mean, the planted acreage was pretty bullish, and in fact, at least for diesel demand, not for ags, I'm just saying for diesel demand. So maybe the we'll keep watching the diesel market, obviously, because there are also maintenances coming on. So diesel could make a nice comeback. It is interesting that if you looked at Midwest diesel prices, naturally they spiked like right after that planted acreage came out.
yes,
And now they're getting hammered.
yeah.
So
So there's plenty of supply around, or as
yeah,
needed.
I guess.
Yeah,
Or
interesting. So, what are we keeping an eye on? We want to look at how are we going to know when? Well, I guess we'll look at diesel exports from China. How are we going to know when China starts using the demand starts surging versus them buying crude oil to run in export?
yeah, I think again we'll keep looking at the import numbers, which were heavy for March. Maybe there'll be less exports available because domestic demand is stronger. We'll watch the Singapore market to get a handle on what's going on in South Asia and China. So, and that's like as both of us have said, that's big. That's big for this market.
Hmm. Okay. Thanks, Andy. We'll pick it up next month.
Okay, and just if anybody wants to get a hold of me, I'm at Lebow, Alebow at commodityresearchgroup.com. And you can definitely find both Jim Colburn and myself on LinkedIn.
Yeah, as I mentioned, I do. I'll try to post something as I see it. If it's interesting to me, I post it on LinkedIn, and I have a I interact with people more there than anywhere else. Okay, see you next month, Andy.
Okay, Jim, thanks.